All right, all right, all right. Sorry for the late start. They updated my software again today, and every time they do that, it screws everything up. So I had a little technical difficulty. All right, my name is Lan Turner. I am the school teacher from Utah Tech University, and this is our laboratory class. We're going to talk about the stock market today. We're going to practice what we preach. Of course, we are on summer break right now, so this is our summer class, our lab for the summer class. But the markets have been going crazy, crazy, crazy lately, but they're doing exactly what we expected, right? This is no surprise to any of us because you've been in this class, you know how to read the charts because what we do is we read the charts like we're sitting at a blackjack table, right? We know the odds and we play the odds. And if you don't know the odds and you don't know how to play the odds, you shouldn't be trading. It's simple as that, in my opinion. All right. Now, I'm going to show you that right now here on Palantir. I'm going to show you how to play the odds. And I'm going to show you and teach you what it is that you need to do. Now, it comes from several different models that we all bring together, that I all bring together. Now, I went, and as many of you know, for the new guys here, I went and worked back in Chicago at the Chicago Board and Trade for about 10 years. All right. Now, I wasn't there to be a student. I was there to teach people how to use computers. That's what I was there for. All right? I wasn't there to teach people how to trade because I was just a young man at the time, and I was there to teach people how to use computers, how to trade on computers. That was my job. I was teaching how to trade on computers. Okay, and so I got to sit like a fly on the back wall of the education center, and so I got to listen to all of these wonderful educational lectures on how to trade from right there at the Temple of Doom, Temple of Finance in Chicago for about 10 years. So that was, I like to consider that to be my education. All right. I did get a formal education, went to Utah State University, went to a couple other schools, but I my formal I don't even count what I did at the university because as far as what we're concerned, I didn't learn anything there that helped me here. All right. So where I learned my education was at the Temple of Finance in Chicago at the Chicago Board of Trade for 10 years. Well, I worked there teaching people how to use computers, but I also became a trader myself, and then of course a speaker, and then of course an educator and a trader. Started teaching people what I learned there. Now, what we do is we combine to trade. We take all the knowledge that we learned for 10 years of sitting in those classes and we combine that into a single trading strategy. Okay. So what we're going to do is we're going to take the strategies from multiple different systems and we're going to combine them together. What a lot of people call old school stuff. All right. But it works. It still works. So the old school stuff is what we're going to learn here today. Is kind of like Yoda, right? He's kind of got the force with him. And so we're going to be doing some old school stuff. All right. So the first thing we want to do is we want to talk about the underlying structure or the base foundation of your trading. And we're going to do that here on Palantir. And you're going to learn why I sold 100% of my the shares that I had left, I sold out right there on that first red candle. All right. First red candle to make a new low. I sold it all right there. Why did I know? I didn't know, nobody ever knows, but the probabilities and the way that we read the charts told me it was time to get out of Palantir right there. And I'm going to show you why. All right. So the first thing we do is we look for a bottoming pattern down here. We have to go way back in time. And I saw this big pullback in the market right here. And this is what I saw. Okay. So the market rallied up. It came down. It made a nice little what we call an ABC pattern on the way down. So I have little tools in this software that we use, and it came right down. You can see just like a train on rails. I mean, you couldn't make it any perfect. Right straight out of the manual. What manual, Lan? My manual. I have a manual. Yes, of course, I wrote all this stuff down so that you could have it. And if you want what I have, just go out to Amazon and get it. It's an Amazon book. It's under Lan H. Turner, and I don't make any money off of it. If you buy it, Amazon makes all the money. I don't make a dime. Amazon makes all the money. But it's full color, 8.5 by 11. You can open it up, read the book, and it has all this stuff in there. Okay, and you can follow along. It's a workbook. It's not like a comedy book or it might be a comedy book. I don't know. It's not like a book you're going to read. Well, unless you want to be put to sleep at night, that'd be a good time to read it. It's a workbook. You lay it out on your desk and you use it to help you identify these different patterns in these different systems that we work through. All right. So this thing came in, and it's a nice little ABC pattern, perfectly timed, perfectly driven right down to the 61.8. Many of you know that 61.8 is our golden ratio, and that is a perfect little setup right there. So that mark came down, and when it turned around and started going back up, this actually ends up being another pattern in here as the market breaks above this previous high. So I come in here, and what I do is I come in and I say, all right, I'm going to draw myself what I call a spider web. All right, now that's just my little pet name for it. It's really just the speed fan. So for those of you who want to do a little study on your own, you can go out there and you can read the speed fan. Okay, so this is how the speed fan works. So you draw that across there, and that becomes 3 different locations through that drawdown point. All right, and we get those little drawdown points. We draw that. I think it looks like a spider web, like a spider went in there and filled in a little spider web. Okay, so this is your natural trend line, as you can see, and it's coming across the top here from top to bottom. And when it breaks that natural trend line, that's kind of where we see this first green candle to make a new high, and that's a buy signal. All right, that's an entry point right there for your long position. And so we started putting positions on right there. Okay, small positions, and rightfully so, because we're not exactly sure if this market's not going to make one more ABC down, right? Because it can come down off that top like this, from this C point down to the 61.8, back up, make this little peak right up in here, right? And it can make another drop. So it can go down into what we call the third drive down. So this is just drive 1 down. So this is drive 1. This is a counter trend. This is drive 2. This would be a counter trend, and it could go to drive 3. Now, it's rare that on the downside that the market goes to 3 drives down. It usually just goes to 2 drives down and then starts back up. Doesn't mean it can't. Certainly can. Market can do anything it wants. We're playing probabilities here. All right. So the probabilities are that the market's not going to go 3 drives down. So when we hit the second drive, this is where we'll put some money in. Just a little bit. We ride into it on this A1. This is called the A1. It's your A1 entry. Now there's 3 A1s. All right. So don't let that confuse you. It's just the spider web tells you the A1 entry. All right. So what I do is I just say this is the A1, and I come in. This is our first drive, or our A drive, and this is the first entry of the A drive. So I just put that right on that blue light. All right. Now that blue light is in this case I got to set the parabolic SAR, and we actually have a tool called the bulls and bears, and this is kind of the primary tool that we use. And you turn that on, you can see it changes the price bars to red, yellow, and green. But that's a little bit more advanced tool. It also does part of the other tools that we use. Or I can remember we use multiple tools. One of them is Fibonacci and the Fibonacci ruler, and this sets it up so you can see where the Fibonacci neutral zones are, or what we call the Fibonacci sweet spot, right between 38.2 and 61.8. So that's what those yellow bars are showing you right there. So if I was to take a Fibonacci ruler, for example, and draw that in there from top to bottom, notice the yellow zones are right there in that Fibonacci sweet spot. That's the neutral zone. That's why that does that. So if you come in here, you can say, well, land, this yellow spot wasn't in the middle of that big run. Well, what you do is you come in here and you draw that in like that. That's where our peak was right here. So that's where you draw your Fibonacci ruler, right? And so then that's where those yellow bars ended up right there, dead center. But then you're like, well, what about all this? Well, that's your Fibonacci extensions, all right, a projection. So you come in here and you can display the projections, and that's where you get this next series of lines. All right, so that's how that works. So again, just to give you a quick insight of how that tool works, it's all the same thing. We're doing the same thing. That just helps you. It's a little bit more advanced when you use that bulls and bears. All right, so in the beginning, I like to kind of turn that off and start off kindergarten level, and then we can turn that on and start using that as a more advanced tool later. All right, helps people. I don't want to confuse you right out of the gate. All right, so then we're coming in here. So this is our little ABC pattern down in here, and that's what we're looking for. So this becomes the turnaround point. Where it's going to turn around, is it going to turn around here, or is it going to turn around on the next one, the third one? What about the fourth drive down? Well, those are so rare that once it gets down there, we're no longer in a bull trend. We're in a bear trend. We don't want to be looking to go long. We want to be looking for short positions. And so this is where this market starts to turn around, starts to go back up. Now that's the A1. So I'm going to clean all this stuff off and delete all the 1, 2, 3s. And let's get rid of all the arrows to delete all the arrows. So that becomes our A1. Now, technically speaking, the A1 is, there's three A1s, right? The breaking of the first natural trend line, which is the red to green, that's A1. This is also A1, and then this is also A1, all right, the breaking above the previous high. So that's just your A1 entry right in there, whichever one you choose. Now, in the book, I label them a little bit differently. I kind of come in here because we got on the speed fan, we got this little, so it's A1 I, A1 I, A1 I. All right, so that's how you read that. But that's in the book. Again, I don't want to confuse you. Just realize that there's 3 entry locations under an A1. So that's your A1 entry. And then you come in and we get the first little pullback right in here. Now, this is where many of you are going to be familiar with this little strategy. It's called the pennant formation, right? So there's where you get pennant formations. And that right there, that first little pennant formation is called the A2. All right. It's not a B drive. We're not into a B drive. We're still in the A drive. It's just the A2. Because what we're looking for is we're looking for an A3, which is right here, this little pullback. So there's an A3. All right. Now we don't generally go to A4, A5, A6. We not that we can't. We certainly can. But we don't generally go much higher than A3 or A4. All right. And so what you're going to get is another little pennant formation in here, and that's that little pullback in there. Those little red bars in there as the market rallies, pulls back, rallies, pulls back, rallies, pulls back. Now you can measure each one of those little ones. This is called a fractal. All right. So you come in here and you run that in there, and you can see that the market rallied up and then pulled back into the Fibonacci sweet spot, those red bars. And then you can measure each one of those with your Fibonacci ruler, because that's kind of what we're measuring here. Now, this one didn't come all the way back down into the Fibonacci sweet spot. These small ones oftentimes don't. They don't get big retracements. They're down to 38.2 is usually pretty good. But that came down, hit the 30, got the red bar in there, and turned around and started going back up. But that's that little pennant formation you're all familiar with. All right. Now we come in and we broke the blue lights. All right. The mathematics come into the game right here. Now, remember, this is all mathematically modeled. And you ask this question, well, why does this work? And where did you find this model? It works because the big institutions make it work. All right. And they make it work with the retail trader. So the retail traders buy into these big runs, and then the institutions, they sell out of these runs. That's what this chalk and money flow is down here. So the chalk and money flow comes in, and it goes in and it shows you this is where the big institutions are buying. This is where the big institutions are selling. This is where the big institutions are buying. You ever heard that saying? I don't know. Maybe some of you have heard it. It's called buy the valleys and sell the rallies. All right. Buy the valleys and sell the rallies. Buy the dips, right? Everybody's heard buy low, sell high, but nobody does it. All right. It's pretty rare to find somebody who actually does it. So the big institutions, they do it, but they do it mathematically with computers. So the computers are calculated and they do it for them. And that's why as more and more and more institutions use computers to do the trading, which they are, right? And you've heard me talk about before, some of those of you who are been in this class before, Aladdin, which is BlackRock's computer system. That's the name of their computer traded system. They started licensing that out to like all these different companies. You can go, if you're a big hedge fund and you want to license Aladdin, if you got the money to do it, you can license Aladdin and you can use Aladdin to trade. And lots, I don't know how many, but I've heard numbers, at least 10 of the biggest hedge funds in the world, the trillions and trillions of dollars, are all being managed through multiple companies using the same algorithmic system. That's why this has become so prolific. Now, it's always worked. It's worked back in the days when I was a young man, and they were just getting into computers, starting to do it. But I learned all this stuff at the Board of Trade. I come and created this software so that people could trade this idea and concept that I learned. And the guys that I was sitting in class with, they went off to Wall Street and they created Aladdin. All right. So it's all comes from the same guys that taught us all how to trade, my generation. So we've got this all programmed into computers, and it's becoming, because Aladdin is becoming more proliferated around the world through all these big institutions, it's becoming more almost easier to read, like a book, right? You can, if you know the odds and you know how these guys program their computers, you can pretty much read what they're doing. And so we're kind of doing what I like to call reverse engineering the Aladdin model. Now, one of the things that this thing is structured on, and I want to bring this up for you and show you, is this is the foundation. And I started talking about that earlier, is you have to build yourself a foundation for your model. All right. And so it's just like a house. You have to put in the concrete first, right? The basement, if you're going to do one, but you have the foundation and then you build everything else on top of it. So this is kind of the foundation. So if you Want to write down this name, you can go study it on your own. It's called Richard Wyckoff Accumulation Distribution. There's lots of great places out on the internet that you can study Richard Wyckoff. Of course, you can ask ChatGPT, give me a quick summary of what is Richard Wyckoff's accumulation distribution model. And this is what we're going to go through. Now you can see I've got each one of these labeled. This is down here. This is called the accumulation stage. This is how the big banks and hedge funds trade. And these are the models that they run through. All right. So this is your 3-drive pattern. So this is where they buy in. The big hedge funds, they all buy in down here. And then remember, for every buyer, there's got to be a seller. So we have the retail trader and we have the institutional trader. And if you think about the stock market only as two individuals, two people. All right. Retail trader, institution trader. That's all there is. There's two traders. The whole market is built around two traders. And for every buyer, there has to be a seller. So when the retail trading is buying, the institutions are selling. All right. And so when the retail trader is selling, the institutions are buying. So always think about when you're getting ready to sell, who's going to buy your trade, or when you're going to get ready to buy, who's going to sell you that trade. It's going to probably be an institution. All right. Now, not necessarily. Sometimes you can, retail traders will trade amongst themselves, and, same on the other side. The institution traders can trade amongst themselves because there's multiple institutions, there's multiple retail traders. But for the most part, overall, on the longer term, trend of things, it's the retail traders are buying while the institutions are selling, and then the institutions are selling while the retail traders are buying. All right. So this is the accumulation stage down here. Now, this accumulation stage is where the retail traders are generally selling their shares. All right. They're getting out of the market because the market's coming down. And retail traders, generally speaking, 80-20 rule, 80% of the retail traders are selling out at the bottom. All right. They buy high and they sell low. They lose money. That's how retail traders trade. Whether you like it or not, that's what retail traders do. And I'm sure you probably, if you look back and you've got much history of trading, you probably analyze your own trading and find that you've done that on occasion yourself. Now, we're trying to break that pattern. All right. We want you to accumulate the same time that the big banks and hedge funds are accumulating. That's why you're here in this class, is to learn how to do that. So we want to buy low and sell high, but this is the structure that we do that with. And I want you to study Richard Wyckoff accumulation distribution model on your own. That's your homework. All right. So what happens is the big institutions come in here and they start to load up. Now they buy very quietly, buy, sell, buy, sell, buy, sell, buy, sell. But over the time, they accumulate a large number of shares down here in the bottom accumulation stage. And they have a great big, huge position down at the bottom. All right. I call this triangular pyramid buying. So they have a big wide base on their pyramid and they're building a big pyramid. And then what they do is they pop the market. They first spring it down to try and get all of you retail traders, all of us retail traders, because I'm part of that group, right? Try to get us to sell that very last piece of shares that we were hanging on to. We get out of that thing and we sell it to them because they want it. All right. There's something called the float. I'm not going to get into all that. Sometimes the float gets a little tight and there's not enough shares for everybody to buy. So they pop the float, try to get you to give them some some more shares, the very last shares they can get all the retail traders to give them just before they start to run the market. Okay. And then they start to buy. Now they are so big, they can control a lot of these markets. All right. To some degree. And so they can make these markets either pop down or pop back up, and they can pop you think they don't know what a MACD is? Yeah, they know what a MACD is. Do they know that 90% of all retail traders buy and sell off of a MACD? Yeah, they know that. And so what they do is they say, well, we need all of the retail traders to start to buy so that we have somebody to sell all of our shares to make money. So they pop your MACD and give you a buy signal. They do that on purpose. All right. They also do it on the other side too, to get you to sell out. They pop that MACD so that you'll sell your position so that they can buy it, and then they run it the other direction. You ever felt like that? Like the market does just exactly the opposite of, like it knows exactly what it needs to do to get you to sell and buy your positions at the wrong time? Yeah, that's being done on purpose. All right. So these markets move these, and it's not being done by a man. He's not sitting there. So this is some dude, some high school kid or some college graduate sitting there with a mouse in New York City in a big, tall, high-rise building banging on his mouse. That's not what's happening. It's being done by algorithms, computers, and systems. They can read the markets. They know what you're doing. They know through their mathematical algorithmic systems what they need to do to get you to sell them your shares. And so they make the market do that. All right. It's all programmed in, and you can read it like a book if you understand and know what they're doing. And then the market starts to run. They run it, they pop your MACD, they give you a buy signal, and you start to buy in, and they start to sell out. All right. So remember, two people, two traders, retail traders, institution traders. You're buying, they're selling. So why are they selling? Well, they're selling as the market rises in price. And so what does that do? They have a big, broad base to their pyramid, right? And what they're going to do is they're going to pinch that pyramid to the top. So when the market comes up through all these patterns that we just talked about over there in the Palantir stock, this is your little reaccumulation, or what we as retail traders call our pennant formations, right? It goes through a couple of pennant formations, and then it gets all the way up to the top, and they have a distribution section, and then they run it back down the other side. So it ends up being what we call an Elliott wave. All right. So the Richard Wyckoff accumulation distribution model is an Elliott wave. So an Elliott wave, now that's another thing you got to go study on your own. I'm going to teach you a little bit about Elliott wave, but that's another thing that you got to go learn. All right. You got to learn some of these old tricks that Yoda taught, right? Got to learn the force. So you got count, measure, setup, trigger, and follow through. Those are your strategies. Count, measure, setup, trigger, follow through. What are we counting? We're counting the waves of the market. All right. That's our probabilities. Okay. It's like sitting at the blackjack table in Las Vegas, and you're counting cards. If you don't know how to do that, you don't have no business sitting at a blackjack table, because you're going to get your hiney handed to you. All right. You got to know the odds. You can go into the store down there in Las Vegas and buy the odds card, and you put that on the table and you read the odds, and the odds will tell you what you should be playing at any given time. Right. Well, we have the same thing for the stock market. You can go in and you can read the odds. We have a little odds card. It's in the book. Lan H. Turner. You have to put the H in there or you can't find it. All right. So Lan H. Turner on Amazon. And in that book, it's not one card, it's a couple of pages, but it has the odds in there for you and shows you what the odds are of the different levels of the market going through the Richard Wyckoff accumulation distribution model associated with the Elliott wave and the Fibonacci rulers. All right. So Fibonacci, count, measure, setup, trigger, follow through. What are we counting? We're counting the waves. How many drives are there? Drive 1, drive 2, drive 3. Measure. What are we measuring? We're measuring the Fibonacci ruler, the Fibonacci advancements and the pullbacks, what we call the delta cone of probability. That's my name for it. All right. So we have the delta cone of probability. That comes from options trading. For those of you who are familiar with options, you know that we work with delta. So we have the delta cone of probability. That's how another way that we count and measure, and we know how to do this stuff, right? Might sound a little complicated, a little sophisticated, and some of you are getting like, oh my gosh, am I ever going to figure this out? It's not that hard. All right. I'm going to take you through the process as soon as I get through this little measure thing. So then we count, measure, setup. What's the setup? Well, that's the trigger for entry. How are we going to get into the market? That's your little patterns, your little pennant formations, triangles, wedges, head and shoulders formations. Those all fit right into this model. Okay. And then we have count, measure, setup, trigger. What's going to trigger us to get us into the market? So we have the setup and then the trigger. So the setup is the pattern. The trigger is the breaking of the pattern. That's when we get into the market. So there's specific places that we need to get into the market for the optimal entry, right? And then the follow through. That's how we get out. We got to know how to get out, because you got to buy low, and the other side to that is sell high. If we don't do that, we don't recognize or realize our profits. A lot of guys want to just put their money in and leave it there for 30 years. Well, you can do that, but then you're not going to exponentially compound your money. You have to get more shares to exponentially compound your money. So if you just buy 100 shares, and then in 30 years, you sell your 100 shares, you only have 100 shares. You didn't do any exponential compounding of your returns. And that's the beauty and the magic. We've oftentimes said that exponential compounding of your returns in the stock market is one of the 7 wonders of the world. And if you're not doing that, you're not participating in that world, you're missing out on one of the 7 wonders of the stock market world. So we need to compound, all right? And the way we do that is we need to sell. And so if we buy, but we never sell, we don't compound. And the way you compound is by getting more shares. So the name of the game in trading is getting more shares. The more shares you have, the more money you can make. Just holding shares for a long period of time is not compounding. And that's linear growth. And you're not going to get rich, rich, rich beyond your wildest dreams doing that. All right. So yes, compounding is hard, because you're not just going to sit there and work at McDonald's and take all your money, buy shares, because that's not compounding. That's just buying more shares linearly. And we don't want to be linearly traders. All right. We want to be compounding trading. So you have to get more shares. So I always think the name of the game is to get more shares. And you don't want to have to buy those shares with the money that you're earning at McDonald's. You want to make the money that you're making in the market make a profit and then buy the more shares with the money from the market. Okay, that's where you get your exponential compounding, is when your trades, your money starts working for you and starts buying more shares. All right. You got to buy more shares. That's the name of the game. The whole name of the game is to accumulate more shares, and not from your McDonald's money, but making the market itself buy you more shares. That's why you have to buy and sell to exponentially compound. Now, you don't have to exponentially compound. Don't feel like that's a requirement. It's just that if you want to participate in the world of the seven wonders of the world, of the stock market, of exponentially compounding, you got to get more shares, and you got to make your trades accumulate more shares for you. And that's done through the process of buy low, sell high, wait for the market come down, buy more with the profit you made, and buy more. All right. So that's how you get more shares. You do the accumulation distribution, and that's why it's called the Richard Wyckoff accumulation distribution model. So that we can come through this, and this is how this model works. So we're going to take this off the screen. We're going to come back, and I'm going to show you that this is exactly how Palantir went through it. If you look at this again, if you look at this pattern right here, all this up, drive, up to the top, that's exactly what Palantir did. And that's why I knew to get out of the market right there. So we come in and we go into what we call the second drive. Now, the second drive, admittedly so, got a little funny right in here. It's not as pretty and perfect as some of the other markets, had little breaks in there, kind of confused us a little bit. But once the market took off and showed us its hand, we realized that was all one drive right there. Okay. So we ended up saying, okay, this is the B drive right here. See where it first break on that blue light? That becomes our next drive. That's our B1. All right. So we have three drives, the A drive, the B drive, and the C drive. And that's what we get in the Wyckoff accumulation model, which is also a combination of what we get using Elliott Wave. Okay, so we get the three drive pattern. So now we got another drive coming in here, and it's coming up like that. And you can see that we got a couple little breaks in here. Now these little breaks are a little bit bigger in this one, but that's okay. Hindsight's 2020. We can come in here. We're nowhere in the B drive. So this comes in. And this is B2 in here. And then, of course, right up in here, we get a little B3. So it's a little bit, it's not as clean and lovely as we like it to be, but it was there and you could see it. But really, the name of the game is going into that C drive, okay? So at the C drive, now we don't know. Sometimes it doesn't go into a C drive. Sometimes the C drive isn't very big. Usually, traditionally speaking, the B drive is the big one, all right? We get a smaller A drive, a nice big B drive, and the C drive is a little smaller. But in this case, the B drive was about the same size as the A drive, not really as clean and smooth and wonderful, but there you can see the B drive coming into the B3. And so this was, and it really didn't give us a really very good spider web in there either, did it? So we can come in with our little spider web tool, and we can see that on Palantir, we got kind of a little spider web in here, almost just like that. So that was our spider web on Palantir. And you can see the first this would be the B1 right here, the breaking of the natural trend line, B2 or B1, the second B1, which is the blue light, and then the third B1, which is the breaking of the previous high. So right in there, I just put it on the mathematically calculated blue light, call it the B1, all right? And then that's the B2, and then we end up with a B3. And right in here, this is our C1. So we're going into the third drive. We call that the C1. Now, each time we get with a higher drive, the probabilities of success become lower and lower, right? So if you're sitting at the blackjack table and you look at the table and you say, well, are the probabilities high or low that the market's going to continue to rise here? Well, the higher it goes, the B drives are pretty confident that the market's going to continue to rise. We get to the C drive and we start to get a little nervous. We're like, oh, is this market going to continue to rise? So we're going to go through the three drives of the C drive. Now, in this one, we come in here. There's the C1. And we can come in with our little spider web here real quick, and we put our spider web in here. There's the natural trend line. There's the mathematical trend line across that blue light. And then we have the horizontal trend line across the top. Now, that horizontal is important because it becomes another Fibonacci number in here, what we call the Fibonacci bow tie, all right? So that's another number that's very important to us across the peaks of these, because this valley right down in here comes back usually to the peak of the top of the previous drive. All right. So that's called a Fibonacci bow tie. And we tie those off like this. So I'm just going to draw one in here for you. So this is a Fibonacci bow tie. We go from this point down to this point, and we go all the way to the top of this point, and then we expect the market to come back down to that level right there and draw off to that Fibonacci bow tie. And look what it's done. Just like a train on rails. I keep saying, it's a train on rails, right? I mean, if you know how to read the charts, you can read the charts and you can get this thing, be pretty good at making good, what we call swags, right? Scientific wild ass guesses. So this becomes a C2, and then this, of course, comes in, and this is a C3. And so this little, let's just tie that in there, that little first little pennant formation right in here, just like that. And then this one right down in here, this is the C3. So right there. All right. So that's your next little pennant formation. We'll just draw that in there real quick. You can see your little pennant formation. And so those are our little hesitations in the market that give us an opportunity to get in. So we're counting, we're measuring those little movements in the market. How far is the market rallying? How far is they pulling back? And then the setup and trigger. So the setup is those C2, the breaking of the C2, the first green candle, make a new high. That's where you get in on that little pennant formation. And you can add on to your position as the market goes up to a C1, C2, C3. You can add on, but as it gets up into those C3 tops, this is where we start to worry, hey, this thing's going to break and fall. And so whether you're breaking and falling on a B1, on the, the A3, the B3, or the C3 is the lowest probability of all. So right up in here, when I got my first green candle or first red candle right in there at the top of a C3, what did land do? I pulled the ripcord. Woo! It's out, gone, nothing. I ain't going to take that risk anymore. I ain't going to get in. I ain't going to hold through that thing. That's a nasty place to be holding the market. That's me sitting at the blackjack table looking at the dealer having a two aces, and I'm sitting there with a pair of twos. What am I going to do? I'm going to fold. I'm out. I ain't going to play that game. All right. So that's how we were able to read this market, and that's how I know. I don't know, because I can show you a number of times where this breaks the rules, where it didn't do this. But most times in these big markets that are controlled by the Aladdin algorithm, the markets do this just like you're reading a book. All right. So as long as you understand this process, you can have a much better chance at winning at this market. So now I've taken all my positions off. I bought low. I accumulated my shares all down in here. I sold some out a little early. I sold some out in here, right? Not all of it, just a little. And I sold out a little bit here. I sold out a little bit here. I sold out the rest of it right there. So I got out as the market went up. I dollar cost averaged in down here. I put in a bunch of shares in here as the market came through these trends. I averaged in. I averaged in a little bit more up in here. And then when the market started to get up in here, I started to average out, take a little bit of my risk off, right? You've heard that term, risk off, risk on. So I took a little bit of my risk off, and as that market started to advance, by the time it got up there to the peak, I didn't have much left, right? And I'm out. But that's what the big institutions do too. They do the exact same thing. So in this Wyckoff accumulation distribution model, which you can see that this market went through it like a train on rails. I mean, my little model here, and I didn't draw this after Palantir. I drew this. This has been drawn this is like 30 years old, all right? This little model. And this is the model that's being used by these big algorithms. This is how they do it. And so as this market moves through this time, they buy down here and then they sell out all the way up the trend, which is exactly what's going on here. So you get into this distribution state. Now we're right up in here. This is what this red zone right here is. It's this part right here in the Wyckoff accumulation. So what are we going to expect? Well, if we were to lay that over the top of it, we're going to expect this type of a move. All right. So we're going to look for this market to come down. Now, it come down and it touched that Fibonacci bow tie, which is that previous high right there. And that's a real important zone. And if you notice, it's the same one over here. We got a little bow tie right here. Boom, 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 right there. It came back down and you tie that bow tie off. Now, it's not always an exact perfect bow tie, but you usually see that little bow tie in there. That's where that market has the areas of support and resistance, and then support becomes resistance. All right. So you've heard that before. Support becomes resistance. Resistance becomes support. That comes from this little bow tie pattern right here. And of course, there was another one right down here. So we get three basic bow ties in this market, right? Just like that. And the market, this one didn't come all the way back down to the bow tie, which was right there. It had a little bit too much strength and it stayed high. So the bow tie wasn't perfect. It didn't come right back down to the exact previous high, but that came close. And that's that little Fibonacci ruler that we put in there, and we measured that distance right in there like that. Okay, so it came down pretty close to that 38.2, bounced off the top of that Fibonacci sweet spot, and away it went. Market was a rocket ship. Okay, so that's how that works, and that's how you do it. Now, down on the downside, how do we measure this? Let's come in here, and we generally get an ABC pattern, right? So A, B, this come down here. We're starting here. We might get another low. We don't know where it's going to be, but we'll get the first green candle to make a new high. We'll anticipate a little bit of a rally in there. I like to use the Fibonacci bars because it shows it just a little bit cleaner. You can turn those off if you don't like them. But that's what the market would look like without Fibonacci. And you'll notice that when you turn on Fibonacci, it's almost like voila. It's like the angels sing. All right. So there you go. That's Fibonacci. And it's like, whoa, it's like beautiful. So we come in here, and then as that market comes down, we're going to anticipate a break and a rally higher. Now, a lot of people will jump in right here. They'll start getting in. They'll think, oh, I'm going to miss out. It's time to get in. Now, it doesn't mean that the market can't go on there. It's just really super low probabilities. You're sitting there with a pair of twos, and she's got a 10 and a 9. All right. So the dealer has a 10 and a 9. You got a pair of twos. Are you going to play your hand against her? You might want to fold. All right. Or not take the hand, because what we're going to do is we're going to anticipate that this market's going to come down. It's going to go back up. Now we have to label this coming down the other side too with A's and B's and C's, because you can get a 3-drive pattern coming down the other side as well. And so we can come down here, and I'm going to grab that. We're going to come down, and we can go down with this next one down. We come down to 100%, and we'd anticipate some sort of a pattern like that. Now, if we were to try and predict out, a long ways, we could kind of give kind of an idea of where this market's going to go with this little projection tool, this Fibonacci projection tool. And then we'd come in and we'd anticipate we're going to go this one. Let's do one more just for fun. We're going to go in here like that, and we'll anticipate that's where this thing goes. Now, that's if we get a 3-drive pattern down. We'll drive 1, drive 2, drive 3. So often, actually, that would be a 2-drive, because we're going to take this up to here, and we're going to bring this one down a little bit more. All right. So we're going to say this one's going from here. So that is our 3-drive pattern. Now, some of you have heard of a head and shoulders bottom formation. That would be your head and shoulders. All right. So you're going to come in here. That'd be your left shoulder. This would be your neckline. This would be your head. This would be your neckline. This would be your right shoulder. And that natural trend line. Now, a lot of people trade natural trend lines too, right? They like to trade what we call progressive trend lines across the top. And when it breaks that progressive trend line right there, that would be your buy or your entry point into the next long position. Now, you can buy the dips down in here if you want, and that's what some of us like to do. I'm not going to buy the first dip. I'm going to wait and see if we can't get a second dip, and then this is where I'll buy, and then this is where I'll buy. So I'll start going through what we call the accumulation stage all over again over here, and this will be the accumulation stage, and then we'll jump on with the big speculators that are going to rally that market to go back up. Now, is this exactly how it's going to look? I don't know. We don't know until it happens, but this is the probabilities somewhere along this lines. Now, we also have something going on right now in the month of September, and we talked about this on Tuesday in our class. And this September is the worst month of the year, right? It's the worst month of the year, and I got that little chart I'll pull up just to remind us. This is the September seasonal chart, and it's the worst month of the year. Now, the reason it's the worst month of the year is because this is where we're going to do a bunch of tax loss harvesting, right? I'm doing my tax loss harvesting. Are you? Are you harvesting for taxes? Okay. If you don't know what tax loss harvesting is, that's another thing you need to go and research. You're going to search Wyckoff. You're going to search accumulation distribution. You're going to search Elliott Wave patterns. You're going to search Fibonacci. You're going to do your research. This is your homework, all right? And then you're going to also research the seasonal nature markets, which is the September seasonal pattern, which is for tax loss harvesting. So that's another thing you're going to research. Write that down. You're going to go study tax loss harvesting. And then you also need to understand the rule that you've got to hold it out for 30 days, all right? So make sure that when you do your tax loss harvesting, you have the rule where you have to hold your money out if you sell it. Like I sold out of Palantir. Now I can't get back into Palantir if I want to realize my tax advantage of doing that. I can't get back into Palantir for another 30 days. And so you have to make sure you research that as well. Okay. Okay. Now we're going to come in here, And we got that coming in. So we got to remember this market's dropping a little bit early. It's starting to flush because we got to the top of the third drive in here, and all the mathematical algorithms said this is where we need to get out. But September is our bad month, so we still got another week before we get into September. So I think we're going to get this little second drive down. I think we're going to get a little ABC pattern in here. We can take our Fibonacci ruler, and now we've measured the little ones, right? We measured each one of the A drive, the B drive, and the C drive with our Fibonacci ruler, so we know where the 50% pullback, 61% Fibonacci sweet spot is on. And get the circle. So each one of these tools right here, right? We knew where that Fibonacci sweet spot was on each one of these Fibonacci's. Now we're going to do from the entire thing, from top to bottom. We're going to go from here all the way to the very top of that Elliott Wave pattern. And that's the 3-drive pattern. Ooh, we're getting so many drawings on here that I can't find a blank spot. There we go. So now we're at the very top. Now the Fibonacci sweet spot is right here for the entire, or the delta cone of probability, right, is right here for this section here. So that's why we're anticipating we draw this. This is where we think this market's going to come down to, and it's going to wander around down in this region somewhere for the entire month of September. We're going to watch this because we're going to start doing an accumulation, right? We're going to start getting in when we start getting some opportunities to put some positions on. Do I want to put my position on right here? I don't. I don't think this market's going to go up and break new highs and keep going up with a fourth drive. I think we're going to get an ABC pattern here because that's usually what we get, and that's what's programmed into most of these algorithms. So this is what we call the X1. Actually, I'm going to come in here and we're going to go back because we have to mark up one more section on these, and that's the exit points. I know we're getting a lot here, but look, you've been with me this whole time. You understand what all this drawing means. Actually, I'm going to take, how can I take some of this off to help us? We're going to come in here and we're going to label the bottom side of this. So we have the first X. This is what we call X1. All right, and the X1 is the first exit to the A drive. So that's the breaking of the blue light. That's X1. And then we have in here one more. This is X2. So that's just the exit point, just getting out of the second drive right in here, right? The end of the second drive is what that is. So this is the end of the third drive up in here called X3. So X3 is when that third drive ends. And of course, you don't want to be in the market any longer. It doesn't mean it can't go to a fourth drive, certainly can. It's just the probabilities are really super low. You're sitting there with a pair of twos at this level. And so you don't want to play against the market with a pair of twos. Up here in this region, you get a really low probability the market's going to go up into a fourth drive. So that's the X3, the third exit, the exit of the third drive. Now we're going to come in and go down the other side. So we have to count down the other side. So as this blue light comes in and we end up with a where's our speed fan? So we come in with our speed fan, we're going to get speed fan 1, speed fan 2, and speed fan 3, horizontal, right? So right in here, it's going to break that blue light, and that's going to be what we call our X1 to the downside. So it's S, X1 short / A1. All right. So it's an A1. It's the first A1 to the upside, but it's an X1S. So the X1S, first exit to the short side, the first A1 to the long side, really low probability. It's a pair of twos. Can you win with a pair of twos? You can. All right. Pair of twos can still win. But I don't like to play the pair of twos because it's a real low probability. So now we come in, and the next one down, which is down in here, we're going to get that blue light. It's going to come down and break. We're going to get this thing in this flush, going to break this new low, come down here and give us this little bow tie. And right in here, right down in here, this is where we're going to get an X2S A1. X2S A1. Now X2S A1, you're sitting there with a 17. All right. That's a pretty good hand. You can play a 17, maybe even consider an X2S A1 on the downside right in here. This might even be an 18. All right. You're sitting there with a 10 and an 8, a jack and an 8. All right. You're sitting pretty with it. I would put money on that. I will buy that every time. I will put money. I will stick my chips on that X2S A1, and I'll put sometimes, depending on the market. Now we're going to go into the fundamental nature of markets, and we're going to look at the fundamentals, right? Not just the technicals. Is Palantir a good company? Is it somebody that we think is going to make money over the long run? Is it somebody we want to have our investments with? Yes, it is. Okay. So X2S A1, boom, that's a good place. I'm going to put some money on that thing. Maybe even, not back the truck up completely, but almost. And then right in here, I'm going get this right in here, if I get a little A2 in here, actually this would be an A1, and if oftentimes this little thing comes in right in here, with this could be a B1. All right, so this would be our A1 drive up and then come back in. This is our B1, and it's gonna maybe something down here with that little right shoulder. We've got lots of tools in here to get rid of some of them. So you find the one we want. There we go. So right in here somewhere, we're going to get this little B1 in here. All right. And we'll have to wait and see. That's where we're going to get another little spider web down in here, right? Little spider web, first green candle to make a new high. And that is going to be a high probability. We'd back the truck up on that baby right there out into that region there. And we would literally have almost all of our money in the Palantir at this point, because this is going to be our accumulation stage down in here. This is where we're going to be buying, accumulating like the big institutions are. All right. So that's the drive down here. Now, is it going to be down that low? I don't know. It might happen up here. It's going to happen in here somewhere. We're going to get these little ABC patterns and these little dips that we can buy in on. Okay. So that's what we're looking for. And we got to remember that month of September is the worst month. So probably coming into October, when everybody gets there, because you have to sit out for 30 days when you sell to take advantage of that. All right. So now that you've sat out for 30 days, that means that puts us out into October for this market to go to the moon, October, November, and December. And that's where we're going to get the next 3 drive pattern. Now, just to break this all up into one whole thing, this whole little model that we've just built out here, this whole little model is called one Darvas box. All right. So the whole thing from top to bottom, that's called a Darvas box. And now the Darvas box, if we come in here and we look at the Wyckoff pattern, all right, that's one Darvas box. So from this point to that point is one Darvas box. And now we're starting to go through the reaccumulation, and we're headed off into the second Darvas box. All right, second Darvas box. So now out in here, this is already coming in, and this is our next Darvas box. And we're going to anticipate that this Darvas box is going to end up with higher highs than this previous high. See this high here? This is where we're going to go in. We're going to go ABCs. We're going to get our 3 drive pattern up, and we're going to expect it to go up, and it's going to be higher than this one. This is where we get an uptrend. This is what we call a bull market. Okay, so we're still in a bull market. We just have to go through the Darvas box, finish that out, go through the reaccumulation stage, let us make more money so that we can take this thing back up. Now, remember, this thing is completely and absolutely manipulated by the big algorithms, and this is the models that they run. All right, this is them doing this. And then we, as the retail traders, we are the opposite of them. We're the ones that they have all the money in the world. And the only money they don't have is the money that's sitting in your pocket, and they want that too. So this is how they take your money. Okay. If you're smart and you know how to read this book, you can trade like they do, and you can start taking other retail traders' money who trade just the opposite of this, who they start to buy all the way up this uptrend and end up with what we call an upside down pyramid. So then they have a huge position, right, up here at the top. Most retail traders have a great big huge position up here at the top because they've been buying all the way up that uptrend. Oh, this is such a great stock. Oh, it's such a great stock. And so all their position in the dollar cost average, their average entry is way up here at the very peak. All that market has to do is fall just a little bit like that, and they start losing all their money. All right. They were so euphoric. They were so wonderful. Oh, I can't lose. I'm so smart. I'm such a smart trader. Oh, look at me. Look at me. I'm making money. I'm out on YouTube telling everybody how much money I'm making. Oh, I'm out on Facebook. Oh, telling everybody how much money they're making. And then they're the ones who lost everything on this drop because they had their average entry way up here. And so their pyramid was upside down. They were trading with an upside down pyramid. And remember, the institutional traders, they were buying back here. So their pyramid was like this, right? They had a pyramid that was like this, actually like this. I got to do it the other way. So their pyramid was like this. Okay, they come up here, and their pyramid was really big, had a great big huge base on it. And let's move it back here because they build it up back here, right? So they build up this great big base here, but when they get up to the top, because they've been selling all the way up the uptrend to all the retail traders, how many shares did they have up there? Almost none. And that's how I did it. I had almost no shares at the top of that trend. All right. So you sell out all the way up, take your profits all the way up. So when you get up to the top, you don't have anything, no risk at those really high probability points of losing money. You don't have all your shares built into the market up there. So when the market falls, you go to the ice cream store and you celebrate. All right. Rather than go to the food pantry and and cry. So this is how this whole system works. Now, that's Palantir. All right, now that I've given you the model, I have just given you the $1 million model. We're going to go look at some of these other markets. Let's come in here and look at AMD. You think that this is just a one-off? It ain't just a one-off. Drive 1, drive 2, drive 3. All right. Let's come down here to Carvana. Carvana. Drive 1, drive 2, failure, drive 3. If we come back, that might be a drive. Kind of got you the little ABC pattern down in here, the little 1, 2, 3. It broke the new low, so that's why we have to start right here. So that's one great big massive long drive. But you can see this would have been our little A1 right in here, right? There's A2, there's A3. You think I made this up? You think that I pulled this out of my hiney? I didn't pull this out of my hiney. It was taught to me at the Chicago Board of Trade. There's B1, there's B2. All right, there's our second drive, there's our third drive. It kind of got tired up here. Wasn't beautiful and wonderful like Palantir. So let's come down and look at Ford. Does Ford have a 3-drive pattern? It does. Look at that. Drive 1, drive 2, drive 3. Not all markets are going to have 3-drive patterns because they're not all being traded and manipulated by the algorithms. So some markets are just kind of random and doing stupid shit and not going anywhere, not doing anything. Well, don't trade those markets because they're not easy to read. All right. You want to be able to read the ones that are easily manipulated by the institutions. And if that's the case, and the institutional systems have locked on into some of these stocks and start trading them, well, they're easy to read. All right. The ones that are hard to read are the ones that the institutions haven't started trading. So this one here, a little bit not as beautiful and perfect, but there's drive 1, there's drive 2, there's drive 3. Are you going to be a buyer right there at the top of that third drive? Now I started an A1 here. We got lower, higher. Okay, here's the rule: higher highs and higher lows. So Land started this a little bit early. We're going to put this back here. This is your A back here, Land, right there. This is your B right here. Okay, and then this is going to be a B2 right in here. And that was a B2 fail. So we come in, and now this is actually, we didn't have a B3. This is your C drive right there. Because it's higher highs and higher lows, 3-drive pattern. So this is C1. And then this is going to be right here. This is C2. And then this one right here, this is C3. And that's the first red candle to make a new low after the C3 right there. And in this model, that should fail. That right there should hit the blue lights, and we should get an ABC retracement. I hope it does, because I want to get into. Oh, this is Home Depot. I was thinking that this was Robinhood. It's not. This is Home Depot. Okay, so that should fail right there. Now, that's stop. Auto scale. Stop. I put you where I wanted you. So this is like first drive, second drive, and it kind of got ugly in here. And I think that's why I started that over. So we're going to have to watch this one close. We're going to have to wait and see what the algorithms do on this, because this might be a new, but the whole rest of the market, you got to take into consideration what the rest of the market's doing. The rest of the market's flushing out right here. So we're going to expect a flush out right here, at least a Fibonacci bow tie. All right. So we're going to draw our line across here. Let's do our Fibonacci bow tie right here. Here, we're up to here and back down to where that needs to tie off with that Fibonacci bow tie. All right, so that's our Fibonacci bow tie in there on Home Depot. I don't want to be a buyer right now at Home Depot. I want to see it break and come down and test in this zone right down in here before we're going to start considering Home Depot. All right, but that would be our ABC. That would be our very low probability. If it did come down here, it'd be an X1 SA1. And I'm not really thrilled about buying X1 SA1, and we are going into the month of September. So that's Home Depot. Here's Hood. Here's another one. Let's look at this one. So this is, look at this thing. Holy cow. What a crazy market. It never did. It broke with one light right there. So there's your drive 1 right there. It broke right there. One little drive. There's drive 2. It broke. There's drive 3, and the drive 3 failed. But that first drive was just outrageous. Look at that. So this is your A1. This is going to be, look at this. This is A2, which this almost right in here almost still becomes your A1. I'm going to call that A2, and then we got almost a little A. It's a little pennant right in there. Did we get lower highs? We didn't. Yeah, we did. It's kind of an A3 and A4. You come in here, A5. I mean, look at this market. It's just, oh, wait, those are not A's. We're in the B drive now. So that's your B2. This is your B1 right in here because we got the break of the blue light right there. Oh my gosh, what a crazy market, right? So you could go through and kind of measure that out, but we're getting right up into this peak where we're anticipating this reversal, just like the rest of them. Now, these three lines right here, I laid those in there just because I'm lazy. That's the Donchian channel. And the Donchian channel, I've set that up with 100 on the period. And I do that just because I don't want to always be drawing my Fibonacci ruler in there. And that's just, it kind of mimics the Fibonacci ruler. So that gives you your Fibonacci sweet spot right down in here. And that red line is just the 50% level. So you realize that that's what that is. That's just kind of where that Donchian channel draws that in there, and that's your Fibonacci sweet spot. So that's where we expect or anticipate this market coming back down into, right? Somewhere down in here in this region, so that we can start, getting into the accumulation stage and start buying back into this Robinhood market at the end of this Darvas box, right? So the Darvas box goes to the highest high point and the lowest point, which is back there off the screen. And then we're going to start us a new Darvas box right down in here. When it breaks into that new accumulation stage and starts to go sideways, that's going to be our new Darvas box. And so we'll box that off and away we go, and we'll go into another 3-drive pattern. Okay, so that's that one. That's Hood. We're going to come down here. This is Mags. So this is our Magnificent 7, right? So this is Apple, Amazon, Netflix, Google, all the Magnificent 7. So here's drive 1, counter trend. There's drive 2, counter trend. There's drive 3. What are we going to expect at the top of the drive 3, or the C drive? This is the C drive. We're going to expect that blow off, and we're going to expect the blow off 1, 2, 3. All right, 1, 2, 3, and then we're going to expect that thing to come down off that Fibonacci ruler for the whole entire drive, and it's going to come back down the Fibonacci sweet spot back down in here somewhere, and that's where we're going to start loading up on Mags again. All right. I wish that thing would shut off. So now we're back. Now this is, come on, quit jumping all over the place. And then we're going to come in here. Too many tools again. Send it back, send it back, send it back. I get frustrated. I got my mind going 100 miles an hour, and I can't make my fingers and hands go as fast as my mind. So then we're going to get down in here, and this is where we're going to expect this market to come down. This is where we're going to start looking to buy. And this will be now be careful, because it's going to start looking like it's going to rally again. That's going to be your X1S A1. Now remember, that has about we're going to say this is a pair of twos, all right? Pair of twos. Pair of twos. In other words, it's going to have about let's say maybe I'm going to say a 19% chance probability that if you bought at that point, that the market's going to turn and go back up again. Doesn't mean it can't. It's just the probabilities of it are really super low. I've lost a lot of money buying into X1S A1s. I will tell you, there will be times where you'll get pissed off because you're like, damn it, that X1S A1 took off and went to the moon. But more times than not, a lot more, like 80% of the time, that thing ain't going to take off at an X1S A1. It's going to go up, and it's going to get you all excited to get back in. And that's what they want. They want you to start to buy in there so they can take all your money as they drop it one more time and bring it back down into this region here. 38.2, if we start getting some support at 38.2 right in here, you can see on the Fibonacci sweet spot in here, I'm just kind of making a guess on that projection, 9100, with that little B point being right in there. We don't know where that's going to come in, right? That first green candle to make a new high will be the bottom. But then as it comes down in this region, this is where we're going to start looking for the accumulation. But remember, September's a bad month, so we got to take that into consideration in this particular situation. And so that's going to be rough. Not going to be a lot of buyers in there because they got to sit on the sidelines. Doesn't mean they can't. They certainly can, but we're going to watch the patterns, right? Buy the dips. Look for those ABCs. Look for that head and shoulders formation. Higher highs and higher lows to go the other direction and start buying in, start accumulating, getting our positions in here, dollar cost average as we get down into this lower region. so that we can build up our position so that when that market goes, we're there with it. Okay. Don't all go all in. You don't ever slide all your whole hand ever in. You don't ever do that. And it's rare that you ever pull your whole hand all the way out either. All right. So for me in Palantir, when I went up, when I got all the way to the very top of that C drive, I had a smaller position. I only had like, I don't know. I think I only, what was it? My spreadsheet tells us. I'll tell you the exact number I had. Where's my spreadsheet? It's this Palantir right here. Wait, where did Palantir? There it is. See, I only had $68,000 left. And I had 69, 46, 19, 5,000. I only had $68,000 left. I'd been taking it out all the way down that trend, putting it in, taking it out, putting it in, taking it out. I took out 68,000 right there at the top on that first green candle. I've got a lot of experience doing this. I feel pretty confident in my skills. Some of you guys might have a little bit less confidence in yourself. So do a little bit more dollar cost averaging. The more confidence you have, the less dollar cost averaging you can do, and the more larger positions you can hold through different situations. But use stops. If you're wrong, just get out at that point. Wait until it stops you out and say, well, I was going to try and ride it a little farther with a larger position, but it didn't go, so I got out. Use stops, be smart and be strategic about it, and read the markets. Let's come in here. Here's Microsoft. Holy cow, this was a crazy market. This thing just took off like a banshee. We never did get a much of a 3-drive pattern. We just got one great big long one drive and then a drive, and now we're coming into the retracement. I mean, this thing, we had a couple little breaks in here. Look at this thing. This is just amazing market. This is what you call the Trump train right here. Okay, so we had a couple little spots in here where we could break the market, but it never did break the blue light. We never did get a pullback far enough to break the blue light till clear up here, way up there. That's just craziness. All right, just crazy. That was a beautiful market. We rode that thing all the way to the top. Now I didn't have Microsoft individually. I had it in the fund. I had I had, what is it? Anyway, the Magnificent Seven, which wrote all those up. Okay, so we're going to come in. Let's look at a couple more. Here's NVIDIA. I made a ton of money on NVIDIA. So this thing here was drive 1. There's your little counter trend. We got one break. Drive 2, counter trend. There's drive 3. We're at the top. That's the C2 right there. C2 is where we failed. So it was a C2 fail. It's got to fail at some point or else it doesn't fall, right? So it could be a C3, C4, C5 fail. One of them is going to fail. We usually fail on the third C3. Oh, crap. I hit the wrong button. Anyway, you see the 3-drive pattern in there, and now we're looking for the little ABC retracement. We're going to finish off that Darvis box from here to here. And when we get back down in here, we go through the new accumulation stage, which I think might be a little delayed this time due to the fact that we're in September. We're going to go and we're going to be ready to load. We're going to start loading up for bear here in October. All right. We're going to look for this market to go to the moon in October, November, and December. It's just going to be in my opinion, October, November, December this year is going to be the biggest move in the market you're going to ever see in your life. This thing is going to just absolutely be unbelievable tear to the upside. And why do I say that? Well, for one, it's perfectly lining up with our 3-drive Elliott Wave pattern, our accumulation distribution model. It's going through the September model, which is just, I mean, it couldn't be laid out any clearer. You'd almost think that Aladdin, the computer system, sat there and said, well, let's go back from September. Boom, 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 3 drives. It's almost like he figured it out and he said, we're going to drive this market down. And so we can have a full 3-drive pattern going up into September, because here's your 3-drive pattern going down the other side. Drive 1, counter trend, drive 2, counter trend, drive 3. Look at that. I mean, it's just like, it's becoming so ridiculous. These big markets that are controlled by this big algorithm, it's just becoming absolutely asininely ridiculous. How obvious is like a big clown nose on your face that these things are manipulated and controlled by these big algorithms. No, it's not, Lan. It's CNBC, it's NSNBC, it's MSBNC, it's CBA and ABC News. They know. They're the ones. They're the ones telling us what to do. I'm going to just follow what they do. Oh, yeah, just like that in politics. You're just going to follow them around and believe everything they tell you. It's the same thing. It's a bunch of bullshit. This whole thing is one great big mathematical model and controlled by the giant people with trillions and trillions of dollars. It's all one great, and what you see it right there. I can't make it any clearer. Look at how stupid this is. I mean, it's just stupid. People, just trade the system. All right, there's Palantir. We look at that one. Snow. There's another one. Snow. We like Snow because you can get a look at that. Holy cow. That thing should have broke right there, but it didn't. So there's your drive 1, drive 2. It's just too pretty. I just look at this. It's just, it's just so gorgeous. Oh my gosh. Look at this one down here. Drive 1, drive 2, drive 3. Counter trend, counter trend, counter trend. You guys should all be rich, rich, rich beyond your wildest dreams now. Tesla, look, this thing was the closest thing to the Wyckoff accumulation model I've ever seen in my life. I did a video on this one and did the layover, right? The overlay on this one. So you can see this coming in. There's your accumulation zone right there. The market went up, made its little deal here, and went up, hit this little spot right there. Look at that. Perfect. Just like right out of the manual. And then down the other side. Down the other side it went. Whew. Flushed right down the other side, just like, I mean, I need to take a picture of this and put it in the manual as an example. I mean, it's that good. Now we're going into a little triangle formation here, and it's breaking out the top. Now, the problem that we've got with Tesla, I anticipated, and I told you, I said, you watch. This single breakout comes down, and I drew that center right down the center. I said, oftentimes market will break out and come back to the center line before it goes again. Now, is it going to go again? That's the question. I don't know, because these things fail too. Right? They go down here. Now, am I got money on it? Yeah, I do. And it's dipping. So if I get a green candle, I'll probably put a little bit more in there because I have faith. I believe that Tesla's going to rise. The problem is it's a bad timing. It's bad timing to be getting into the market right now because we got September coming. And everybody's going to sit on their hands through September, and it's going to be the end of that month where this thing's going to take off and go to the moon. Now, is it going to take off and go to the moon? I don't know. Heck, it's Tesla. But if it's manipulated by the big indexes, it's going to go to the moon. It's just, when are they going to do it? All right, when are they going to start buying this thing up? Stupid Elon got political, and that kind of messes things up. All right, you got to take into account the fundamentals of the market. But Tesla is definitely one that is being driven by the algorithms. So that's one we're going to play. All right, so we're going to come in here. We got United Health. Now that's a whole nother story. Oh my gosh, you guys. There's an article in Pitt News Magazine about this one. Speaking of Pitt News Magazine, we've got Claire sent out her podcast yesterday about a really good article written by what's his name? He's new to the staff. So Thorne. So Thorne. Is that his last name or his first name? Anyway, he's new. That makes me feel bad. I forgot his name. If he sees this, he's gonna feel bad. I forgot his name. Anyway, Thorne. And Claire did a podcast on him. All right. So it got posted to the podcast system, which is now I can't even remember the name of the podcast system. What the hell is the name of that? Anyway, Apple podcast thing. And then there's that other podcast thing that Joe Rogan's on. Anyway, that's where she posts it. She posts it on the same one that Joe Rogan's on. It's a music service. Anyway, that's where she posts them. And it's supposed to automatically go over and post on our channel on YouTube. But for some reason, it didn't post. So she's asked me to go see what's wrong. I got to go do some tech support on that and see if I can't figure out why her video, her podcast didn't post. So if you want to watch her podcast, Spotify, Kirk's in there with me. There you go. Kirk, Spotify. So it's on Spotify. So if you guys want to watch it, go to Spotify. I'm going to see if I can't get it to show up on YouTube, but for some reason it didn't pass by itself. So we're going to get it on YouTube eventually. But right now it's on Spotify. If you want to watch it, it's really good. But Thorne also wrote a article for Pitt News Magazine in the October issue on United Health about this whole drop right here. Oh, it's a good article. It's highlighted in Pitt News Magazine. So if you guys don't have Pitt News Magazine, you got to get that. What? What's Pitt News Magazine, man? Of course, everybody here knows already what Pitt News Magazine is, but I'm sure there's one guy in here who's brand new and he's never heard of Pitt News Magazine. So for those of you who have, can you sit through this just for 1 second while we teach this guy about what Pitt News Magazine is, all right?
Ready to level up your news game? Welcome to Pitt News Magazine, where stories come alive. Read it, hear it, or watch it in our YouTube classroom. Right now, get your first 2 issues for just $1. Yep, only $1. Don't love it? Cancel anytime before the $39 yearly fee kicks in. Try it out, risk-free. Satisfaction guaranteed, or your money back. Visit pittnews.com. That's pitnews.com, Pitt News Magazine. News your way.
All right. So I will, here in just a minute, I'll give you the ad for where you can go get Claire's. There's Pitt News Magazine and then there's her podcast. My brain's starting to run low. So there's her podcast. And so those are 2 separate things. Pitt News Magazine costs $39.95 a year. And then her service, her little podcast is free. All right. But it's associated. You go to Pitt News Magazine, pittnews.com, go to pittnews.com and you can sign up for both of them. Okay. I'll let you have her ad here in just a minute so she can tell you about it. But I want to come back and look at Walmart. We were playing with Walmart. So why are we down $1,300 on Walmart? These are put options. Did we sell them or did we buy them? No, we got, it's a long position. We were learning about, this is a lesson. This leftover from a lesson that we had on synthetic long positions with covered calls. I was teaching you what Palantir does. Not Palantir. Yield max. Oh my gosh, my brain is shot. I was teaching you yield max. I was teaching about yield max, the yield max funds, and I was teaching you how they trade, and that's what that is. And now you can see Walmart's flushing. That's not good. Okay, but did we get a 3-drive pattern? Not really. This is a different pattern altogether. Let's delete some of these things. This would come in with our first drive in here, and we thought we were going to get drive 1, but then the B drive failed, and then we went into what we call 3 times a charm. So this is charm 1, charm 2, charm 3. And what it looks like is an accumulation stage. All right. So you think, well, they're getting excited about it and they're going to run it one more time and it's going to go up and we're going to get a pullback and another rally. So if you take your Fibonacci ruler and you go from the top of this trend to the bottom of this trend, this is where we would expect this market to come back down into, which is right here, which is it's failing. It should hit. Actually, I drew that upside down. Let's do it like this. There we go. All right. So that is 38.2. And that's where it's sitting right now. That's a buy signal, actually. You can buy at 38.2. But given the fundamentals and everything else is flushing right now, I'm not real excited to go long right here, especially not where we've already got a synthetic on there. But this is the Fibonacci sweet spot for this market. And this is going into, again, we're going into September. So you have to remember, not real thrilled about being a buyer in September. We want to be loading up, getting our positions built up in here so that we can go with October. Oh, I was going to show you one more time. I was going to show you. That's October. Look how big October is compared to September. So September is always shitty. And then, oh, crap, I just said a bad word. Now I'm going to have to, I was trying to be so careful not to say a bad word so that I didn't have to go to YouTube confessional. All right. So now we got to come in here and look how good October and November are. That's what we're so excited about. And then we drop off a little bit in December because we're going into the end of the year and people are taking profits. A lot of people will do their tax loss harvesting in December too, but most of us like to do it in September. Okay. That's it. That's the game. So that's what we're coming into. All right, guys. Hopefully this has been helpful today. We went through and we saw which ones to buy, which ones to sell. That's YMAG, YMAX, YBIT. These are all of the, let's, one more I want to see. NVDA. Did we look at NVDA? Oh, we did. Let's go look at AMZN. Amazon. Drive 1, counter trend, drive 2, counter trend, drive 3. We're up here making our little ABC pattern. Just like, you guys, I'm telling you, if you learn how to read this market, you read it like a book. We're reverse engineering the big algorithms, and that's what we're doing. And that's why it's consistently works, is because it's programmed into a computer, and they just run the program over and over and over and over and over again for years and years and years on end. And the market just does it over and over and over again. All right. It almost doesn't matter what the news is. It almost doesn't matter what politics are. It doesn't matter. Almost most of this stuff doesn't matter. I mean, the big things do, the interest rates, the Fed, the government spending trillions of dollars like Biden did, dumping it into the market. And that kind of stuff manipulates and changes things. So you always have to be mindful and be aware of that. Most of you are news hounds anyway, and you're paying attention, but don't pay attention to the little stuff. Just the big things, the big market moving things, the stuff that, they're obvious, like what the Fed's doing. That's going to make some differences in the market. What the president does with these big, huge money spending bills and where that money's going. We just brought Thorne on. What's this? I forgot his name. Thorne. Somebody help me. Somebody help me. Do I need to look it up? No, it'll take me too long. All right. So his name, he's a Washington correspondent, and he's now working with us on Pitt News Magazine, and he writes articles for us and tells us all about all this government stuff that's going on and government contracts and all kinds of things that are going on in the market, so we can look at some of these. Really fun to have him because he's really smart. He's really, really smart. So watch for his article in Pitt News Magazine this month. He wrote 2 articles for us and sent them in. We're publishing one in Pitt News Magazine. The other one, Claire made her podcast about. So that's all I got for you today. I hope you guys had this. It's fun. I'm going to run you a little ad for Claire just for fun for her podcast, and then I'm going to go see if I can't get it on YouTube for us. I don't know why it's not out there. It should have gone by itself. But here's Claire's article.
Hey, Claire here. Guess what? Mr. Turner handed me the mic. I've now got my very own podcast, Pitt News on Air, your new weekly hit from Pitt News Magazine. Join me every Wednesday for stories, interviews, and a little behind-the-scenes scoop. We're live on Spotify, and yep, now on Apple Podcasts, too. Visit pittnews.com to follow. Come hang out with me and the gang. We're all there. Jake and Lena, of course, Lan Turner, David Duty, Dr. Scott Brown, Jordan Black, and even Aiden shows up on occasion. We're having a world of fun. Don't miss out. Pitt News on Air. Because news should never be boring. It's where your trading friends are. Follow us wherever you get your podcasts.
All right, there you go. So go over and subscribe to Pitt News Magazine. While you're there, subscribe to Claire's podcast, and I will go figure out how come it's not on YouTube. Do some tech support over there. All right, guys, we will see you bright and early Tuesday morning. We'll come and do it again and see where these markets are at. But I'm betting you we're going to be in a little ABC pattern. We're starting to come back down into this market. Give us some opportunities to buy back into these markets as they pull back. But remember, September's bad month, so we gotta be strategic about our re-entries. Don't get excited. Don't get too excited. All right, we'll see you then. Take care.
All right, that wraps it up for today. If you got something out of this, do me a favor. Like the video, subscribe to the channel, and share it with someone else who's trading or learning.
Hey, don't forget to tell them to subscribe to Pitt News Magazine.
Oh yeah, definitely subscribe to Pitt News Magazine. You'll thank us later.